Every Ponzi scheme ever created shared one problem. The math guaranteed it would collapse. Not a risk, not a possibility. A certainty, written in numbers, visible to anyone who stopped to do the arithmetic. And yet, millions of people joined. Smart people, banks, funds, regulators watching up close. Which leaves a question far more uncomfortable than how the scam works. If the collapse is mathematically inevitable, why does nobody get out in time? The answer is, the reason this scheme is still running. Right now, somewhere near you. Here is the entire mechanism in one sentence. There is no investment. That's it. That's the whole trick. The returns paid to early investors are simply the deposits of later investors, passed backward with a smile. No trading, no product, no profit, just money moving from the back of the line to the front. Which sounds impossible to hide, until you realize the machine produces something more convincing than profit. It produces proof. The first investors really do get paid. Real money, on time, exactly as promised. They tell their friends bring money, and the machine feeds itself. From the inside, everything checks out, because the one thing you would need to see to spot the fraud is the one thing no investor ever asks to see, where the money actually comes from. So if it is this simple, why does nobody notice? Because a man in Boston designed the disguise so well, we named the entire crime after him. Boston, 1920. Charles Ponzi promises investors 50% returns in 45 days. Double your money in 90. And here is the part almost nobody knows. His idea was legal. Ponzi had noticed that international postal reply coupons, small vouchers used to prepay postage across borders, cost less in Europe's collapsed post-war currencies than they were worth in the United States. Buy cheap there. Redeem dear here. That is arbitrage. It was legal in 1920. And it is still legal today. If Ponzi had stopped there, he would have stayed clean. But the coupons were slow, the paperwork was heavy, and the money was pouring in faster than any coupon could move. So he stopped buying coupons and started paying old investors with new investors' cash. The machine, fully assembled. By that summer, he was pulling in $250,000 a day. At the peak, nearly 75% of Boston's police force had money in the scheme. The people paid to catch the fraud were inside it. And then one journalist sat down and did something no investor had bothered to do. He did the math. Clarence Barron, a financial journalist, asked one question. If Ponzi is really buying postal coupons, how many would he need? He calculated the volume of money flowing in. Then he checked how many coupons actually existed in the world. To cover the investments, Ponzi needed roughly 160 million coupons in circulation. The real number? 27,000. Not 27 million. 27,000. The entire empire was resting on inventory that was off by a factor of 6,000. One number. That is all it took. And Barron found something worse. Ponzi did not invest in his own scheme. He had told reporters he kept his personal fortune in real estate, stocks, and bonds, assets paying 5% a year. Sit with that for a second. The man offering you 50% in 45 days trusted his own money to 5% a year. Why would anyone choose 5 over 50 unless he knew exactly what the 50 really was? That question ran on the front page of the Boston Post. Within weeks, the scheme was dead, which leaves us somewhere uncomfortable. If a journalist with a pencil could kill it in 1920, why does the same scheme still work today? Because the modern versions learn to hide the math. They wear disguises, and you have almost certainly seen at least one of them. Every disguise is coming up next. Stay with me. Start with the disguise hiding in the name itself. Most people use the words Ponzi and pyramid scheme as if they mean the same thing. They do not. And the difference decides who does the dirty work. In a Ponzi, you are passive. You hand over money. The operator fakes the returns. You never recruit anyone. The fraud is centralized. One liar, many believers. A pyramid inverts it. You only make money by recruiting people below you, who recruit people below them. The scheme outsources its own growth. Every victim is converted into a salesperson. A Ponzi hides where the returns come from. A pyramid tells you exactly where they come from, the next layer down, and dares you not to care. Both carry the same death sentence. They need endless new money. But the pyramid has a crueler signature. When it collapses, its victims are not just broke. They recruited their own family, their own friends, and they have to explain it at the dinner table. So what happens when a pyramid puts on a suit and calls itself a business? Type 3. The multi-level marketing company that crossed the line. Multi-level marketing is legal as long as the revenue comes from selling real products to real customers. But when the actual money comes from recruits buying starter kits and hitting monthly quotas, the product is a costume. Underneath it is a pyramid with a tax number. Here is your test. If a company makes more money from the people selling than from the people buying, you are not a distributor, you are the customer. Type 4. The High-Yield Investment Program. The online version. A slick website. A trading bot that does not exist. 1% daily returns. A dashboard showing profits that were typed, not earned. It is Ponzi's coupon story rewritten in code, and thousands of them launch every year. The tell is the promise itself. Real markets do not pay a guaranteed 1% a day. Nothing does. If a return has no bad months, you are not looking at an investment. You are looking at a spreadsheet. Type 5. Affinity Fraud. The most personal one. The operator infiltrates a community that already trusts itself. A church, an immigrant community, a profession, a group of friends, and then lets the trust do the selling. Nobody audits a brother. That is precisely the design. And it means the person who brings you in is almost never lying to you. They believe it too. They were paid, just like you will be, right up until the money stops. Type 6. The Crypto Ponzi. New vocabulary, identical machine, staking rewards, guaranteed yield, a token that only rises because new buyers keep arriving. When the inflow stops, the token does exactly what Ponzi's coupons did. It turns out there was never anything underneath, and here is the tell. If the yield is paid in the same token you bought, nothing has been earned. Money has only been moved. And Type 7, the most common of all, the legitimate business that slipped. A real fund takes a real loss. The manager hides it, just for 1 quarter, covering old clients with new deposits. He tells himself he will fix it. He never does. Most Ponzi schemes are not born, they are improvised, which brings us to the man who improvised for 20 years, inside the heart of Wall Street. Bernie Madoff was not an outsider. He was a former chairman of the Nasdaq Stock Exchange, a Wall Street legend, running a fund that people begged to get into. And behind the legend, the largest Ponzi scheme in history, roughly $64 billion in fake account value, built over 2 decades, with more than $18 billion in real losses. His statements were immaculate. His returns arrived with supernatural consistency, around 1% a month, every month, in every kind of market. Real markets do not do that, and one man proved it. Harry Markopolos, a financial analyst, reverse-engineered Madoff's numbers and concluded they were mathematically impossible. He did not whisper it. He sent detailed warnings to the SEC, the federal regulator, for years, including a report in 2005 backed by 14 years of data. The response? Dismissed, repeatedly. The watchdog was handed the math, and the watchdog looked away. Which destroys the most comforting belief we have about fraud, that somebody competent is watching. So if the alarm rang for years and nothing happened, what does it actually take to bring one of these down? If you want to recognize the next one before it reaches someone you know, subscribe. That is what this channel is for, making the invisible obvious. Here is what outsiders always get wrong about Ponzi victims. They assume greed. They assume stupidity. The record shows something more disturbing. The scheme's real weapon is that it works. At first, the early investors receive real money. Their skepticism dies on the first payday, and a paid skeptic becomes the most persuasive salesman alive because he is not selling anything. He is just telling you what happened to him. Madoff's investors included banks, hedge funds, charities with professional analysts on staff. Ponzi's included the police. The trap is not a lack of intelligence. The trap is proof. You can argue with a promise. You cannot argue with your neighbor's bank statement. And by the time the numbers stop making sense, you are no longer evaluating an investment. You are defending a belief that has been paying your bills, which is exactly why these schemes never die from the inside. Something has to kill them from the outside. Here is the pattern almost everyone misses. Ponzi schemes do not die when they are discovered. Madoff survived years of public warnings. Ponzi survived months of newspaper suspicion. Exposure wounds them. It does not kill them. What kills them is arithmetic, the day withdrawals finally exceed deposits. Madoff was not brought down by the regulator. He was brought down by the 2008 financial crisis. Markets crashed. His clients needed cash to cover losses everywhere else. And between September and December, they pulled roughly $7 billion out of his fund. There was no $7 billion. There was never going to be. The scheme that survived every investigation could not survive a bank run. That is the universal law behind every type in this catalog. A Ponzi does not die when people stop believing. It dies when people stop depositing. And those are 2 very different moments. So, the question we started with, if the math guarantees the collapse, why does nobody get out in time? Because leaving requires you to believe you are wrong, while every piece of paper in your hand says you are right. The returns are landing. The manager answers the phone. Everyone around you is still in. To walk away, you would have to trust an abstract calculation over your own lived experience. Human beings almost never do. The math says it fails. The bank statement says it works. The statement wins. Right up until the morning it does not. Charles Ponzi learned that ending personally. After prison. After deportation. The man who once collected $250,000 a day died in 1949 in a charity hospital in Rio de Janeiro. He left barely enough to cover his own burial. The scheme still carries his name. The money never stayed with anyone. That is every type of Ponzi scheme. One machine, 7 disguises, and a single line of arithmetic that ends them all. The next scheme is already on the table. If you want to see the trick before it sees you, subscribe. I will see you in the next breakdown.